Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills. Let's get to the three things that you need to know today.
First up, Liberation Day coming early, at least for the car makers, as the president pushes ahead with that 25% tariff on autos. We're seeing European stocks falling today as a result. Shares of European automakers slumping, with Porsche and Mercedes-Benz Group facing a potential $3.7 billion blow from the new tariffs on imported cars. Meantime, American car makers mixed today. You've got GM shares falling. You've also got Ford shares moving around a bit this morning. At the moment, they are lower. Meantime, Tesla pushing higher, as some see the company as a winner from auto tariffs, with its large factories in California and Texas churning out all the cars it sells in the U.S.
Plus, on the trade talk front, President Trump threatening sweeping trade levies on the EU and Canada if they join forces against the U.S., expanding a trade war and triggering threats of retaliation. Meanwhile, the president said he would consider lowering tariff rates imposed on China to secure Beijing's support for a sale of TikTok's U.S. operations to an American company.
And meantime, in the U.S., stock futures are pointing to a lower open today as investors grapple with Trump's tariffs, the impact to corporate earnings, and its impact on inflation and the overall labor market.
President Trump unveiled a fresh round of tariffs on car imports to the U.S.
And what we're going to be doing is a 25% tariff on all cars that are not made in the United States. If they're made in the United States, there's absolutely no tariff. We start off with a 2.5% base, which is what we were at, and we go to 25%.
The announcement is being felt across automakers in Asia, the EU, and the U.S. The new import taxes will go into effect on fully assembled vehicles starting April 3rd. Levies on auto parts will follow by May 3rd. Industry experts say the move will drive up the cost of cars for consumers by thousands of dollars. Here to break down the impact is senior reporter Pras Subramanian here. Pras, from what we can evaluate thus far, what does this mean for the car companies, the manufacturers, as well as consumers here?
Man, I mean, it's just I heard someone say that this could cause a recession in the auto industry, right? Just one move of 25% on not just the cars, but also some finished auto parts, like powertrains and engines and things like that. So, even if you're Ford, who builds, 80% of their cars in the U.S., you have some of these parts that are going to be affected in a month, and that's going to be a kind of big problem. But, Brad, you mentioned some of these European automakers. We're talking about the effects there, and I'm looking at this stat here from the U.S. Commerce Department. Germany imported 24.8 billion worth of cars to the U.S. Billion with the B, by far and away the number one importer of cars here. That's in terms of European imports. That's a huge number that's going to be tariffed potentially, right, on August 3rd. So just a kind of a monumental thing here. I know a lot of people think, this is the possibility for negotiations. This is Trump's move to just sort of get this on the table. But it sounds like he's pretty serious about not wanting to negotiate, and this is what it's going to be like for at least the near future.
Do you think the auto CEOs are surprised this morning and surprised yesterday that there wasn't more of a negotiation, or do you think that they're still hopeful of getting that negotiation?
I think they definitely knew something was going to happen.
Yeah.
I spoke to a source yesterday, and they at 3 o'clock did not know what Trump was going to say. At least they claimed not to know what he was going to say. And then if you watched the thing yesterday, he spoke about tariffs on all non-U.S. made cars. And then later on, we got the information about the auto parts, the certain auto parts that came on the fact sheet. So it wasn't known right away how much this would affect the industry. And now we're seeing that. We talk about, I know there's talk about companies like Ferrari and Porsche and Mercedes who are going to be affected severely by there's a heavy presence in U.S. buyers. But at least for companies like Ferrari, it's not so bad because their buyers have a lot of disposable income. They may be okay with spending more on a tariff. But then again, rich people don't want to spend money on things they don't need to. So we'll see how that shakes out.
It's interesting. I was looking through Kelley Blue Book stats here on some of the most sold vehicles during 2024 here. Ford F-Series tops the list. I mean, that's pretty much kind of, you could print that on a T-shirt and print it every year, and it would still be applicable most years for decades at this juncture. But the Chevy Silverado, most of them produced in the U.S., but they also have the Mexico plant that services North America as well here. That was the number 2 vehicle, and mostly throughout some of these vehicles, you're seeing most production that had been moved to service the North American market to the U.S. Some of that in anticipation of what could take place here right now, but also in reaction to what already played out in Trump 1.0 as well?
Yeah, I mean, two things there, right? So you mentioned the Silverado and Sierra. Half of those trucks are made in the U.S. and half of them are made in Mexico,
right? Which
is a big deal. But if you're GM, you thought to yourself, hey, Trump negotiated USMCA last term. Isn't this all cool? We have a free trade agreement between Mexico and Canada. Not the case. So that's a problem. And then the question is, how fast can they reshore that to the U.S.? A new factory takes 2 to 3 years minimum to make, right? So you're not going to see an effect for a long time, other than the fact that already announced projects that are kind of in the works. So yesterday, Hyundai announced an expansion of their plant down in Georgia. They call it the Meta plant. That's for EVs and things like that. So that's a whole other story about EV policy. But you kind of see where we're going with this.
Yeah, and we're going to continue both the impact of these tariffs and also the impact on these auto stocks throughout our programming process. Thank you for kicking it off with the great context. Really appreciate it. Well, new tariffs on auto imports to the U.S. are escalating global trade tensions. Japan, South Korea, Canada, and the EU all vowing countermeasures against that 25% levy on auto imports to the United States. In response, Trump threatening more tariffs against the EU and Canada if they work together against the U.S. Joining us now with this, Wendy Schiller, professor of political science at Brown University. Wendy, thank you for coming on to give us the context that we need on this developing story on these auto tariffs and tariffs overall. If the market believed that these tariffs were very serious, I think we'd be seeing a much bigger sell-off in these auto names this morning. Do you think investors are not taking these tariff threats seriously enough?
Well, Madison, I mean, the Trump administration has already shown that it can announce something and then roll it back. And of course, these don't take effect till next week. So I think in that sense, there's some hope they could be rolled back. But in this case, I think the sense that the reporter just indicated, Trump's going to see what this does. Does he see any movement from U.S. manufacturers to reshore, as you suggest? It's not very easy to do. Do you increase production at existing plants inside the United States? But what does it do to prices of cars? Do dealers, like gasoline prices, frequently go up magically after announcements are made? Will car prices go up immediately? And does that mean that the consumer will feel the effects of these tariffs even before they affect supply chain or before they affect importers' balance sheet? So that's the question mark. Is there a consumer impact, whether it's expectations of the economy or it's whether you're going to buy a new car in the next 2 months? And I think that's what Republicans, at least in Congress, are looking at right now.
Wendy, our own processor of Romania made a good point a moment ago in that we had the USMCA agreement that was praised by Trump 1.0 previously, and a lot of auto manufacturers probably scratching their heads around, okay, what within that isn't still in place at this juncture now that you're seeing this negotiation go forward? So Trump wants the optics of a deal, but how likely is it that we'll just get some of the same things that were already on the table before that give him that optics of a deal and for him might be a checkbox win?
Well, Brad, I think that you're pointing to, the core of the Trump MO, which is cut a deal and claim credit for it, claim victories, doing that in foreign policy and economic policy. And I don't think he wants a full-out trade war, because that will, send us not into a recession, but certainly veering towards one. We rely heavily on consumer spending in the United States. We've already had supply chain issues that led to inflation. So I think when consumers start to think, then they pull back. And when they pull back, it's sort of a self-fulfilling prophecy that the economy slows down. So, and the other thing is disruption is important. We know that innovation, technology, it moves the needle forward. But in policy, government policy, particularly economic policy, you don't want to disrupt so much that you make things unstable and uncertain, because then investment decisions change or they stall, and you create sort of a slowdown in the economy that is not natural, that wasn't going to happen, but for the policy changes that you're implementing.
But Wendy, that uncertainty has already been sort of priced in at this point as a feature and not a bug of this administration. So I wonder to what extent you think we are primed to avoid a recession, given that uncertainty seems to be sticking around.
Madison, this is the question mark. The uncertainty sort of has been resolved, at least in the early months of the Trump administration, because he backtracks. Because he says, well, I was going to be severe, but now I won't be as severe because I got a deal. But he seemed pretty serious about this and holding a line for a little while, and adding auto parts just makes this just a much bigger chain reaction across the U.S. economy than just cars. So there may be some backtracking on auto parts. We'll see, whether there are layoffs coming. United Auto Workers seemed happy with the announcement. Sean Fain making sort of an announcement saying, I'm happy with this. But, given that the Trump administration is not sort of consistent, the question is, does he stick with policies that do actually real damage over longer periods of time now? And in that case, the markets might build this in more than we've seen, and that creates sort of a spin-off effect.
And Wendy, I also want to talk to you about another story that we've been watching, this idea from Trump himself saying in a press conference yesterday that he would be willing to potentially cut a deal with China on tariffs in order to secure the TikTok deal. And this really stood out to me because the Trump administration has said that a lot of the tariff policy is being driven by the goal to end the flow of fentanyl into the United States. We know that China, by far, according to the DEA, is the biggest exporter of fentanyl globally here. And we have that quote on screen right now, China remaining the primary source of fentanyl and fentanyl-related traffic from the DEA's latest intelligence report on this. Is this a sign to you that the end goal on tariffs is not fentanyl related?
Well, I mean, the fentanyl question is such a complicated question. We also have Mexico, as a great source of transit for fentanyl. And, that's been the big impetus to say we're going to slap tariffs on you until you stop, the flow of fentanyl over the border. So is it China through Mexico? Is it Mexico alone? I think they're adding some inconsistency in their messaging on why the tariff, as you call them, taxes, really, import taxes, which the American public can understand much more readily than when you call it a tariff. Even as a teacher, I can tell you that that's true. So I think that's the problem for them, is sort of which is it? And when it comes to China and TikTok, I wonder about the rationale of having it be a U.S. owned company. And does that mean the Trump administration thinks it can exert more direct power over TikTok and that social media avenue for messaging if it's a U.S. company, U.S. owned, rather than Chinese owned? So there could be another motivation for cutting this deal.
Wendy, thanks so much for taking the time here with us this morning.
My pleasure.
Let's get to the market impact of tariffs. European stocks taking a hit today amid the president's announcement, while U.S. stock futures fluctuate and point to a lower open as investors digest tariffs and how they could impact the U.S. and global economy. Fitch Ratings today saying the impact of U.S. tariff hikes are beginning to appear in macro data. Joining us now, we've got Seema Shah, Principal Asset Management Chief Global Strategist. Seema, good to have you here with us this morning. Just help us make sense of the policy negotiations that have been put forward thus far and what type of recession risk profile you're placing on that.
Good morning. Well, I think in terms of the policies that we're seeing come through, the biggest surprises, I guess, has been really in the sequencing to which it's come, with the initial expectation being that there'll be some kind of shoring up of the US economy before you get some of the hits such as tariffs. Of course, that hasn't happened. We start off with tariffs, and actually the impact is set to be more severe than I think anyone was anticipating at the beginning of the year. So from our perspective, the odds of a recession have increased quite clearly. We have concerns about what is going to happen to consumer spending, how the labor market is going to respond to the Doge-inspired job cuts. But overall, we still think that in the second half of the year, we're assuming that there's going to be some good news coming in, either in terms of the extension of tax cuts, deregulation, and hopefully Federal Reserve rate cuts. Now, a lot of that is steeped in uncertainty. Even today, specifically with the announcement of auto tariffs, it really does raise the risk that inflation moves a little bit higher than what people are anticipating, which would make it certainly a lot more challenging for the Fed to move forward with additional rate cuts.
And Seema, it makes me wonder, since you mentioned the Fed and obviously the policy uncertainty, how much is the market relying on either a Fed put or a Trump put, and perhaps both of which are not here anymore?
I think there is some reliance. When we're thinking about at least what the market is anticipating for the Fed, they're only pricing in 1 or 2 cuts this year. So it's not very, very significant. But I think it's the idea that, look, if the Fed was in a position where it couldn't cut interest rates because of inflation concerns, and at the same time that inflation is really eating into consumer spending, then I think the market would certainly respond quite negatively. So we can see this feeding in through today. The market is really responding in a negative reaction because of the concerns around inflation and then what position that puts the US and the US Federal Reserve in.
Now, when you look out to the second half of the year and then pair that with the strategy for equities investors out there, does that seem, especially as we're kind of remembering that equities investors typically look months out, try to look through perhaps the largest shocks. Does that seem then like we may have already seen the bottom, at least for some of the slippage that earlier or over the last month has taken place and transpired?
I mean, I think we may well be. I think there's still some uncertainty to come. And of course, we know that markets really don't like that aspect of this kind of policy environment. It depends on when we're going to get that clearing event. Is it next week on the 2nd of April, or are we looking further out into Q2? But I think that equities already have had, of course, a downshift. There are concerns around what is going to happen to earnings, not just, of course, in the tech sector, but this assumption at the beginning of the year that there would be a broadening out of earnings growth to other sectors is now being tested with a number of announcements that are coming through. So from our perspective, it could be that in some point in early Q2, when you get some level of certainty around exactly what the Trump administration is going to be doing, not just with tariffs, but also with DOGE, with deregulation, with tax cuts, that is when you could see investors starting to feel a bit more confident about how to invest in this environment.
Given that uncertainty is kind of the word of the year right now, Seema, I wonder how you're thinking about diversification in this environment. How are you advising clients on diversifying their portfolios to be able to withstand some of the pain that may come as we await that second half of the year?
Right. And as you said, uncertainty is the number one word. Number two is diversification. I think this year, coming into the year, already investors were starting to think about global diversification increasingly because of the valuation disparity that was on display across the world. And now what we've seen in the last couple of months is that actually countries have looked to reshore. They themselves have shored up their economy in order to protect themselves against some of the cross currents coming from the US. So that has made other countries outside of the US more interesting, fundamental improvement, which I think has added to the case for global diversification. And then in addition to that, from an asset allocation mix, when you have got downside economic risks, you need to have exposure to fixed income, high quality fixed income, investment grade, preferred securities. Those are the areas that you need to be thinking about, as well as, of course, look within equities, global exposure, high quality sectors with high quality, strong balance sheet, strong cash flow, and then also within fixed income too.
I guess further to that end, Seema, just to elaborate a little bit more, within uncertainty, where is the highest conviction trade or asset allocation right now?
It's a good question. I don't know if there is anywhere really that has very, very strong conviction. We are seeing that investors are actually taking more interest in some parts of the world that they feel are less vulnerable to tariffs, that may be almost considered a bit boring in a way because they're not doing much from a policy side or anything. So actually flows into the UK have been surprisingly strong for that specific reason. But I think overall, it's really about fixed income, investment grade, high quality, which provides that downside risk. If you do have, if we are hoping to see Fed cuts later this year, some reassurance that that's coming, that's going to be adding to that case for fixed income.
All right, Seema, we got to leave it there. Thank you so much. Appreciate it.
Thanks.
Coming up on the Morning Brief, we're going to break down the impact of tariffs on auto suppliers and other industries impacted by the levies. Plus, we're going to track the tech trade as AMD drops amid one analyst downgrade on the stock. And we'll count you down to the opening bell on Wall Street as stocks are looking to open in the red. All that next on Morning Brief.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, we got to take a look at auto parts suppliers here on the day. We've got a roundup here for you on the side of your screen. As you can see, we're mixed right now, but following President Trump's announcement that he will impose 25% tariffs on cars and car parts that are not made in America, the duties on cars are set to take effect next week, while those on car parts are expected on May 3rd here. So keeping a close eye on the auto parts suppliers here, even though they are mixed, you're seeing two of those, mainly in Magna International and Dana Incorporated, both moving to the downside on this news. The complexity here around this is really trying to gauge how much of the prices of cars will rise because of tariffs. But on top of that, parts that originate as well, we should note, in the U.S., then go into Canada or Mexico for production and then make their way back into the U.S., haven't previously been subject to some of these, or the tariffs haven't been as high on them because of where the parts originate from and then move back in. We do know that there have been a lot of focus on this from the different unions or the automakers representations as well. UAW, Auto Workers Union, Sean Fain, he praised the move here specifically, but it's really remaining to be seen, of course, until that point in time of whether or not these actually go into effect, what that net pass-through would be to the consumers as well.
And I think, Brad, you lay it out so well in terms of those individual names. And what's important, I think, for our audience to remember is that this is kind of like a layer cake situation when it comes to these tariffs. They're all going to get layered on top of one another. So when it comes to the auto parts sellers in particular, they're already going to be hit by the likes of steel and aluminum tariffs. And then they're also going to be hit by these individual country tariffs as well here. I also want to just quickly note on the broader sector, JP Morgan this morning downgrading a couple of stocks here, Open Lane, Car Gurus, and True Car. But what I wanted to point out here is the broad point that this analyst makes, calling the tariffs unequivocally negative for the entire ecosystem near and medium term. So that's going to be negative for the likes of these companies that we have here on screen, from auto parts suppliers and some other automakers as well. Yeah. All right, well, next up, let's take a look at used car stocks here today, because after President Trump announced those 25% tariffs on cars not made in the U.S., we are seeing a move to the downside in these stocks here. Meantime, Morgan Stanley upgrading Carvana to overweight from equal weight, citing the stock's recent pullback as an opportunity for investors. That follows Citi's upgrade earlier this year to buy/high risk, raising its price target to $277 from $195 on Carvana, citing strong retail unit sales growth. You can see here, Carvana stock down over 2%, Car Gurus down 6%. I think we're also getting a move to the downside off the back of this JP Morgan downgrade of this entire sector here this morning. What's really interesting about the used car space when it comes to tariffs is that you still see price hikes coming into the used car sector. And we see this come up time and time again in the CPI inflation data here, because yes, the car makers who are obviously importing cars from the likes of Mexico have to take on the impact of those tariffs, and then they likely push that cost onto the consumer, raising that price. But then the car industry is one where you typically see a little bit of price gouging, to put it bluntly here. You do see used car prices going up in tandem because they can. Because if you need a car, you're going to buy one. And the question is whether or not consumers are going to be able to withstand that inflationary pressure.
Yeah, some context on this from JD Power. They actually, in their forecast for this year, they note that the average used vehicle price is trending towards $28,552. That's down, get this, just $22 from the same time last year. Now, this actually, they say, reflects this combination that they're seeing: reduced supply of recent model year used vehicles due to lower new vehicle production here during the pandemic, most notably, and then additionally combined with fewer lease maturities, plus discipline from the manufacturers out there that have yet another concern on the tariff front to be really kind of running the calculus around here. But the discipline from manufacturers, they say, to moderate the discounts available on new vehicles. So that's where the used vehicle market is certainly being impacted here, also being influenced by things such as emerging tariff-related price concerns. They had noted in their report just this week, the effect not yet material, won't be until April, well, early April, and then ultimately into the parts in early May. But the effect not yet material, any increase in new vehicle prices, they note, will inevitably lead to higher used vehicle prices.
Right, exactly. This is exactly what the JP Morgan analyst says, saying used car pricing will react instantaneously to these tariffs, meaning that we will see a price increase likely instantaneously the moment these tariffs are applied, saying new car prices could rise 9 to 12% on the back of these tariffs. So a pretty significant price increase for consumers.
Absolutely. And staying within the autos landscape, but going internationally here, finally, Chinese automaker NIO planning to raise about $450 million via a share placement to develop its smart EVs, according to a report from Reuters. Now, this coming as President Trump's tariff announcement weighs on some of the Chinese auto stocks here. NIO, though, and this is typical when you see some of the share dilution, ultimately, as they're kind of going through this $450 million raise. NIO shares are moving lower by about 7.5%. I'm not sure if we can throw up a year-to-date chart for some of the Chinese not used car, but new car makers, because there certainly has been a broader sentiment shift that that we've been tracking over the course of the year-to-date scale for companies like NIO, companies like BYD. There you're seeing BYD on the screen, and this is what I'm talking about, up 50% year-to-date, and it's really the sentiment shift among some of the domestic consumers of those vehicles. Again, remember, if you do have any type of shift in mindshare among those consumers who are looking at some of the U.S. options and saying, okay, well, we want to support more of the homegrown options, then that money will tend to flow towards the companies like BYD, the companies like NIO, and some of the other domestic manufacturers within the Asia-Pacific region.
I think it'll be fascinating to see what happens in the European markets in particular with these Chinese automakers, if they are able to continue to withstand any impact of these tariffs. We've already seen BYD eclipsing revenue from competitors like Tesla, specifically due to a big bump in sales in the European region. Will that continue to be true off the back of these tariffs, and are these companies kind of primed to be able to handle that? I just quickly want to mention some individual company news for NIO, disclosing plans to raise about $450 million through a share placement, according to a Reuters report. So you can see that's perhaps also moving the stock today here. We're going to have all your markets action ahead here on Yahoo Finance. So stick around for more. You're watching Morning Brief. That is your opening bell on Wall Street. Let's get you a check on the markets here. You are looking at red on your screen off the back of those tariff announcements from the president here. You can see we've just been kind of in a tight range this week. Not a ton of conviction, not a lot of huge sells, huge buys here coming in as the market does digest the totality of the policy uncertainty coming from the White House and a little bit from the Federal Reserve as well. But let's take a look at what you are seeing in your major averages this morning here. You've got your S&P 500 off about 0.3%. Your tech-heavy NASDAQ off about 0.5%. And let's get a look at some of those individual movers for your tech-heavy NASDAQ here, because one of the things that was interesting is that we did see a fairly big sell-off in some of those big tech names yesterday. So we were interested to see what we would get in terms of the market action this morning, and you're seeing a bit of a continuation of that dynamic. It's about half and half for your Mag 7 names. You've got Tesla, Alphabet, and Microsoft moving to the upside. Meantime, Apple, Amazon, Nvidia, and Meta all in the red. Apple flipping around just a bit here. Obviously, you want to watch these names because they are so heavily weighted in the broader averages that where they go, so goes the market. Occasionally, though, we have seen a pickup in activity in the other 493. I just want to end by going global. I've been interested in looking at the global market action, just given some of the buying we've seen of equities outside of the United States, given the kind of decline in the U.S. exceptionalism narrative. You can see here on your screen, lots of red in the United States. You're also seeing red in Europe. That's probably off the back of those tariff announcements. A lot of the European automakers set to be substantially hit by that news, especially you see in Germany here, you've got the DAX off 1%. And then you look at China, perhaps some of the Chinese tech news we've gotten this week, some lightness in Alibaba, for example, leading to some gains over in China here. But let's get a broader look at the U.S. market with Jared Blickery. Hey, Jared.
Thank you, Maddie. Yesterday was kind of an important day in the markets. We had a 3-day upstreak that was broken in the NASDAQ, S&P 500, and NASDAQ 100 specifically, also the Mag 7. And what's happening with all three of those is really interesting with respect to their 200-day moving average. They're all rejecting it, and the charts are going to look pretty similar here, but you have this fledgling rally that we've been tracking, and now we got that nasty down day, and everybody wants to know, is this the resumption of the downtrend, or is this just a little wiggle in a new move up? And that's what we're trying to figure out here. So yesterday, the S&P 500 was down 1.1%, but there were more advancers than decliners. So the Mag 7, some of those mega caps really bringing things down, but under the hood, things weren't that bad. And I think that's an important thing to remember here. The VIX has been up 2 days in a row. This is a year-to-date look, so we're just coming off of those lows here, but not by a large amount. Still holding under the 20 level, which is important to some traders. And what I've been tracking here with the bond market and also dollar, the yields have been moving opposite the dollar. So here's a 10-year T-note yield. It is up 3 basis points, but nevertheless, the dollar is down here. And that's just been a recent development in prior epochs in this bull market that began in late 2022. We've seen most of the days they have been synchronized, and not lately at all. Let's take a look at the sector action. I was looking pre-market, things are kind of muted, although tech almost down by 1%, materials down 0.75%. If we look at the 4-day totals here, that's what we're coming into this morning with the weekly look. Consumer discretionary, XLY is up 2.5%. That's an Amazon and Tesla story. And then we have communication services, that's Alphabet and Meta, and then financials. Those round out the leaders there, not by a large amount, but nevertheless leaders. And then to the downside, we're still looking at those defensive lagging here. Utilities, tech's not defensive, but we do have healthcare in there and real estate. So still kind of a bullish setup to the week, just nothing really that convincing. I want to get to the futures market where I'm tracking a couple of different metals. We have gold. Gold is nearing its 17th record high of the year, and I'm trying to get that market. There we go. This is a 4-day look. Let me put the year to date just so we can see who's in the leadership position. That's going to be copper, but we'll do gold here. GC equals F, up 14.7%. And let's put the year to date. You can see right there, pretty close to another record high. We'll have to see how that tracks into the close. And then copper. Copper has been making record highs over the last few days, and that is down just a little bit. But as I said just a minute ago, that is in the leadership position as far as the futures that I'm tracking. So really interesting to see how these tariffs play out, not only in the car market, not only in stocks, but also in the futures market. And I'll send it back to you, Brad, on that.
Jared, thanks so much. Appreciate it. Shares of U.S. and international automakers moving to the downside after President Trump's announcement of 25% tariffs on all cars imported into the U.S. and some auto parts starting next week. So who are on the winners and losers list of the trade war here? Joining us now to break it all down, Greg Migliore, Auto Guide Editorial Director here. Greg, great to have you here with us to help us really parse through what we do and what we don't know at this juncture. But let's just start with your assessment of some of the winners and losers on kind of both sides of the column here.
Hey, good morning, Brad. Thanks for having me. It's kind of a complicated situation because no vehicle, I think, is entirely American-made or fully imported. You know, parts are sourced. It's a global economy. They're sourced from all over. So you look at the companies that are best positioned to perhaps weather this out, and that's Tesla, likely. You've got the Detroit 3, Ford, General Motors, and Stellantis are in better positions, but I think it's also fairly inconvenient for them because while they do rely on their U.S. footprint, they also have many factories in Canada and Mexico. I think of those three, Ford is probably relies most on U.S. production though, so they're going to come out a little bit better right now. And then you kind of break it down into the different international automakers. Honda is in pretty good shape, actually. They make a fair amount of their vehicles in the U.S. Toyota, it's a little bit of a mixed bag. The Tacoma comes from Mexico, so that could be subject to tariffs. On the other hand, the Tundra is built in Texas. The Toyota Camry, top seller, built in Kentucky. So it's a bit of a mixed bag for them. And then you have companies like BMW and Mercedes that do have factories in the South, in the American South, the Southeast, but they don't have nearly as much production here as some of the others. So their exposure is going to be greater. And it's, I think at the end of the day, you put consumers also in the bucket of perhaps people who will be most affected, perhaps losers, because most likely, we're going to see price increases, $5,000 to maybe $12,000 increases, depending on the vehicle and perhaps, how severely they're impacted.
Greg, let's pause there for our viewers who are not just investors, but also everyday consumers. Help us understand where consumers who are in the unfortunate position of needing to buy a car at the moment would potentially see the biggest price increases. Are used cars going to potentially increase as well? We've already seen this record run up in the consumer price index when it comes to new cars. How should consumers be thinking about where they might be able to find some opportunity?
So right now, I think if you're in the market, you really want to just have your head almost like on a swivel. I think you want to be aggressive. I think you want to look at used cars because I think while the intent of the tariffs is to try to, increase production in the United States, what's going to happen is used car prices are going to go up. Just it's a supply and demand, simple economics issue. So used car prices are going to go up. You're going to want to probably do as good as you can to try to get a good loan if that's what you're looking to do to finance your new vehicle or your used vehicle. And it just makes the car buying process much more complicated. Now, I think you might see dealers maybe a little more willing to deal because they know their situation, after April 2nd is going to get more and more complicated. So perhaps, in the next couple days, even this weekend, you might want to try to really get in there and see what you can do as far as perhaps getting a newer used car, because complicated is just underselling it, because right now we know what vehicles and what companies will be affected, but then you start to drill down deeper and it's like even Teslas are only about 80% made in the United States. The Ford Mustang is about 80% US parts because not every single part is built in the US. So it's going to be quite complicated.
And so, Greg, all of this in mind, what season of vehicles, because as we know, typically some of the 2026 vehicles would make it onto dealership lots and whatnot by late summer, early fall. So it sounds like, is this a current this year problem or a next year's vehicles that are in production right now type of problem?
Oh, it will be immediately for this year because the car companies, they have to follow the law. So they're going to have to figure out how to apply the tariffs and how to break down which ones may or may not be subject to the U.S., Canada, Mexico agreement, which was passed in 2020 by the first Trump administration. So they need to kind of parse all of that out. But after, April 2nd, it's, we're going live, these things are going to happen. So it's going to be an immediate impact for consumers and for automakers.
Greg, 30 seconds here. I want to talk about Tesla before we let you go. Elon Musk saying the cost impact on Teslas is not trivial when it comes to tariffs, breaking his 3-year streak of not posting about tariffs on X. How should investors and consumers be thinking about the impact on Tesla?
So I think for Tesla, you're going to look at a couple things. One is pricing, but Elon Musk has shown an ability to be very flexible with pricing. He will be aggressive. He will pull back. Sometimes he's all over the map with pricing. I think with Tesla, the big concern for investors is what is their core model? Elon Musk hasn't been focused very much on building cars in the last probably 2 months. I think you want to figure out what are they? Are they a car company? Are they an AI company? Those are the big questions I have because right now, obviously, Elon Musk seems quite distracted from the task at hand at Tesla.
Optimus wants to know if they're a humanoid robot company, Greg.
That's true. That's a cool one.
That's pretty cool. Yeah.
Greg, we have to leave it there. Thank you so much for joining us. Appreciate it.
Thank you.
Let's get a check-in on the luxury vehicle market amid the tariff news. Moving to the downside today, but Bernstein analysts noting Ferrari could withstand the impact of U.S. auto tariffs because its customers won't be deterred by higher prices, saying despite being in the crosshairs of President Trump's escalating trade policy, new 25% levies on all auto imports into the U.S. will not undermine the case for Ferrari, which produces all of its cars in Italy. Having said that, you got the stock down a little over 2% here. And Brad, this is something that we've been talking about, right? Who has the type of consumer and the pricing power to be able to just raise the price of their cars and have a consumer who is completely fine with that, or who is positioned based on where they are producing and where their supply chains currently lie to not necessarily have a huge impact from tariffs? Those are the two questions, I think, at the moment.
Well, in luxury vehicle sales, too, even as we think about the incentivization, some of the incentivization is just getting them into the ecosystem so that they know that they can trade in and trade up later on, because more often than not, there's a few different ends of luxury vehicles. There's the super high-end luxury where you are custom ordering a vehicle that's going to get delivered to you. It's going to probably cost hundreds of thousands, maybe millions of dollars, and could be a one of one. But then there's the kind of more affordable or approachable luxury end tier where you go up to a dealership and you say, okay, I want that one, but I also want to make sure that if I don't like it in 2 years, I can trade in and get the newer model as well and get some of what I've already paid kind of applied to that next vehicle as well. So I think that's what we're really thinking about here, how this is going to affect some of the more commonly sold luxury vehicles, whereas a Ferrari, like at this juncture, Look, I'm not friends with enough luxury people who are purchasing Ferraris at this point, so I couldn't tell you what their mindset is. But I would say that if they were planning on purchasing a Ferrari this year, they're probably still going to purchase a Ferrari because they have the money.
Because they have the money. Though I will say the street is mixed, and then we'll wrap it up. But we've got about half of the street with a buy, half the street on a hold, according to our Yahoo Finance data. So it's interesting to see the street still having some questions on the stock.
All right. Well, Lego needs to come out with a Ferrari that I can make at home.
There you go.
Then I'll get one.
Yeah.
All your markets action straight ahead. Stay tuned. You're watching Morning Brief.
A growing number of Wall Street strategists are lowering their S&P forecasts for the year, but what hasn't been a feature in many of these calls is a more bearish outlook for the Magnificent Seven and big tech more broadly. So let's get to the outlook for the tech trade. Joining us now, Tony Wan, T. Rowe Price's Science Technology Equity Strategy Portfolio Manager. Tony, great to have you here. So talk to me about where you are seeing the tech trade going. I mean, NVIDIA in particular really getting hit this morning, down a little over 5% at the moment. Where do you see that basket of 7 stocks going to end the year?
Yeah, well, I think that going into the year, we saw kind of this idea that they were spending a lot of CapEx and the numbers are coming more in line. And so kind of the Mag 7 to Lag 7. And here, I think valuations are more attractive. I think a lot of it is kind of the recognition that tech is still cyclical and we have cyclical headwinds potentially developing. And so, I mean, going forward, I think earnings really do matter. I think the ROI on AI is particularly important, and just showing that that there are strong use cases and this CapEx is going to return really well for investors, I think is going to be top of mind.
Tony, I've just been asking multiple people over the course of this week, trying to wrap my head around what makes this technological cycle different versus ones that we've seen in the past where companies' valuations skyrocketed, and then it took them 5, 8, maybe sometimes 12 years to grow into those valuations over time. What makes this AI disruption type different?
Yeah, I think you kind of have to go stock by stock. When you look at the Mag 7, a lot of them are pretty reasonably priced. And I think this cycle has been largely driven by earnings and less multiple. I think in the 2000 dot-com bubble, there were a lot of kind of no revenue businesses, and they were essentially burning a lot of cash. I think this cycle, when you look at AI and how it's funded, it's largely funded by the free cash flow of like a Meta or Tesla. When they're building out AI. And so I think it kind of depends. I mean, obviously Tesla is a little bit more of a kind of AI story, I think, and less of a car company. And so, I think this one, when I take a step back, it does feel more sustainable, but it doesn't mean it's not still cyclical.
And the reason I ask that is it just seems similar to some of the powerhouses that you had that were envisioning and then rolling out the cloud. And so the move to the cloud as well, those companies were well capitalized, but they still had to have a period where they were able to show to investors that they could continue to not just bring in net new customers, but sustain their existing portfolio client base, then build on top of that with everyone else who was going to buy into the cloud and into a different data center that they didn't have to keep on premise.
Yeah, I think that's how a lot of the hyperscale players are viewing the AI infrastructure opportunity, that this is as big, if not bigger, than the cloud opportunity that they had a number of years ago. And so you have to go through that kind of investment period and just the view that the opportunity is just so large, and it is a once in a lifetime kind of shot that they have to take. And so that's kind of fueled this cycle where I don't think we've seen anyone really blink. I think you see some reports that Microsoft is stepping back, but others are stepping in to take that capacity on power.
I also want to get your take on CoreWeave. We have some reporting this morning that NVIDIA is potentially going to be involved in the CoreWeave IPO, anchoring the CoreWeave deal at $40 a share and a $250 million order that could increase. This is according to reporting over at CNBC. What does that tell you both about the path forward for NVIDIA and CoreWeave's IPO, again, cutting their IPO size here, even amid this announcement of backing from NVIDIA?
Yeah, well, I think that the neo clouds emerging over the last few years has been really exciting to watch. They essentially go, kind of closer to the, bare metal and have a more optimized software stack. So I think that in a way, this is the right way to build AI infrastructure from a clean sheet perspective. And so, I think that the market is watching how sustainable is this kind of the model. And then, I think CoreWeave's done a really nice job of being able to finance this and drop costs for their customers and be able to structure this so that it is more attractive for people that are looking to train models and deploy models. So, to me, I think that it is an indication of demand in this new kind of financing structure that CoreWeave's developing. And I think, NVIDIA, CoreWeave's an important ecosystem partner for them because they do kind of stand things up really quickly and efficiently.
Final minute, Tony. I think where we've kind of ranged in our conversation points to the fact that there are a lot of different opportunities in tech right now amid all the uncertainty. You've got private market names going public. You've got the China tech trade, the big tech names in the U.S. They're maybe on sale right now. Where should investors who love the idea of being invested in tech be allocating capital right now?
Yeah, I think you kind of want to have a balanced portfolio. Apple is probably one where it is kind of this kind of safe haven. If things sell off, it's kind of has a nice kind of ballast to it. And, they are going to have an iPhone cycle coming up that could be a big upgrade cycle with a new form factor. So I think there's kind of defensive, ballasty names like that. But then there's also, I think, areas of cybersecurity. There's continues to be a really nice tailwind there with AI probably both increasing the attack surface as well as causing the space to grow more. And so I think that one it's less related tariffs as well, and so you kind of have a little bit more insulation there amid kind of secular tailwinds.
Tony, thanks so much for taking the time here with us just after the market opened this morning.
Thank you.
We've got all your markets action straight ahead. Stay tuned. You're watching the Morning Brief. We're taking a closer look at some trending tickers this morning, and we're doing it in 30 seconds each. Let's go. First up, shares of Winnebago Industries rising. A second quarter beat overshadowing the company's reduced guidance. The RV and boat manufacturer reported adjusted earnings per share of 19 cents versus the 12 cents that the street was expecting. The company's marine division, which was a highlight, with revenue rising 17% over the past year. However, the company did cut its full year forecast with the potential impact of tariffs in mind, and the company now sees adjusted EPS in the range of $2.75 a share to top side of that range, $3.75 a share. It previously saw $3.10 to $4.40. Winnebago says the guidance accounts for price increases that may be required to offset inflationary pressures on input costs.
Plus, AMD catching a downgrade at Jefferies to hold from buy. The analyst says AMD is falling further behind NVIDIA and has, quote, considerable ground to cover before their products can compete. The firm says the gap between the company's chips could widen further with NVIDIA's upcoming product cycles. Jefferies seeing more downside risk than upside potential in the near term. The price target reduced to $120 a share, about 9% upside from the stock's last closing. See, it's down about 2.5%. Both NVIDIA and AMD shares are in the red for 2025.
Finally, one analyst is getting more bearish on Tesla. Tesla's price target reduced to $130 a share from $165 previously at HSBC. That represents a 52% drop from where the stock last closed. HSBC has had a reduced rating on Tesla since they initiated coverage in 2023. The analyst says, quote, the seeds for the current sales weakness predate the recent brand issues. And the firm also notes the EV maker's aging products and limited driver assistance have pressured the company in China. And opportunities like robo-taxis are too far in the future. All the while, the firm notes competitive threats continue to grow.
That's going to do it for Morning Brief. Joining me in the next hour for more analysis on catalysts.